Today you will learn about a couple considering a reverse mortgage and how a reverse mortgage may help them avoid paying capital gains taxes. This true client story illustrates how a reverse mortgage can be a powerful financial planning tool. The other day, I received a call from a sweet lady. To protect her identity, we'll call her Betty. Betty said, every morning she and her husband smile and tell each other, one of us needs to die. And then she giggled. I have a theory that people who laugh easily in old age have had a great attitude for a long time. Betty said the reason for her call was because they had run out of money and they were trying to figure out how to minimize capital gains taxes on the sale of their home. She told me their Eastside Costa Mesa home was worth $2.3 million. However, they still owed about $400,000 on a first mortgage. They had purchased the home more than 40 years earlier for just under $300,000. Betty is 86, her husband is 87. Their retirement accounts and savings are gone. She said they were good savers and lived below their means, they just didn't plan to live this long. Their Social Security and small pension were not enough to cover their $2,100 monthly mortgage payment. They felt like the only choice they had was to sell and move, which they wanted to do. However, she explained that if they sold their home, they'd have to pay capital gains taxes on $1.5 million worth of profit. That is their current value minus acquisition cost minus $500,000 Section 121 exclusion. That equals $1.5 million in taxable profit. Since they didn't have much income, capital gains taxes would be about $1,500,000 times 15%, which equals $225,000. The next part of our conversation reminded me that older people can be very knowledgeable. Betty explained that they held title as community property with right of survivorship. That meant upon the death of either spouse, the property automatically passes to the surviving spouse without probate, and the property receives a 100% step-up in basis for tax purposes. Translation, when one of them passed away, the other could sell the home and not have to pay capital gains taxes, which she figured came to $225,000. A reverse mortgage was the key to the strategy. It would allow them to be able to afford to stay in the home until one of them passed away. Then the remaining person could sell the home, downsize, and not have to pay capital gains taxes. I should have asked Betty about her career. Perhaps she was a CPA or a financial advisor. I reviewed my call with an estate planning attorney who said Betty was right. Betty also knew that a reverse mortgage would allow them to access wealth tax-free. Most important, it would eliminate their existing mortgage payment, which was straining their budget. You can imagine how impressed I was when I hung up the phone. That was one smart lady. We find many financial professionals think of a reverse mortgage as a loan of last resort. This true story illustrates how they can also be a financial or tax planning tool. In Betty's case, the reverse mortgage would be a wealth preservation tool, saving her family over $200,000. If you like this video, subscribe to our YouTube channel for more true client stories. You might also like our new video series, How Reverse Mortgages Work. Please visit our website at www.thereverseadvisor.com. On Facebook at The Reverse Advisor. This article is not intended to be a substitute for or to provide tax advice. You should review these strategies with your own tax, legal, and estate planning professionals. Kent Kopen is a certified reverse mortgage professional. You can reach him at 800-208-1252.